Bitcoin is not going to be the insurance policy that stablecoins are now playing against their fiat currencies. Institutions have been waiting to build positions, waiting for this 4-year down cycle. And therefore, we think that the downside from here is not a lot of the old timers are taking some Bitcoin off the table because they don't want to face another down cycle, which in the early days was down 90 to 95%. I think the last one at its worst was down close to 75%. Today, we're down 30-ish, a little over 30%.
Cathie Wood begins by explaining that Bitcoin is not just a single innovation, but 3 revolutions happening at the same time. First, she frames Bitcoin as a technology revolution, the world's first form of internet-native money, enabling peer-to-peer transactions without banks, borders, or intermediaries. Second, she describes Bitcoin as a global, rules-based monetary system, governed by code rather than policymakers, with a fixed supply capped at 21 million coins, making it resistant to inflation and currency debasement. And third, she positions Bitcoin as an entirely new asset class, one with historically low correlation to traditional markets, which allows institutional investors to improve portfolio returns while reducing overall risk. According to Wood, it's the convergence of these 3 revolutions that makes Bitcoin fundamentally different from anything that came before it.
We have not changed our bull case scenario for Bitcoin, which is above $1 million. Now, from today's levels, today we're a little below $90,000. So that will be more than a 10-fold increase. And our conviction is high because Bitcoin is 3 revolutions in one. It's a technology revolution, really introducing currencies native to the internet, digital currencies, into this peer-to-peer network. That is a revolution. It is also a global monetary system that is rules-based. That is a revolution. It is mathematically metered. Bitcoin is mathematically metered to increase to 21 million units, and we're closing in on 20 million units right now. So we're moving to a point where I think scarcity value, as institutions move in, is going to drive the price higher. And then the third revolution is actually what I just said. This is a new asset class, and institutions have to consider it because the correlation of returns among crypto assets versus traditional assets is very low. And so to put Bitcoin and other digital assets into a portfolio, well-diversified portfolio, will increase returns per unit of risk. And that is what institutional investors are always seeking. Interesting to see a much more subdued cycle. And you're right, we haven't seen the burst that we normally do. One of the reasons is those who have been involved in crypto and Bitcoin specifically for the last 10 to 15 years now have learned that there is this 4-year cycle. Now, it just so happens there's been a 4-year cycle. 2 years after the halving, Bitcoin peaks. And so what we believe is happening is a lot of the old timers are taking some Bitcoin off the table because they don't want to face another down cycle, which in the early days was down 90 to 95%. I think the last one at its worst was down close to 75%. Today, we're down 30-ish, a little over 30%. And we are beginning to think that institutions have been waiting to build positions, waiting for this 4-year down cycle. And therefore, we think that the downside from here is not very significant. Just to give you a little, to dimension that a bit, right now, I think today we're at about 86,000 as we are recording this this video. If we look at where many people think the bottom will be, they think it will be around 74,000. Now, why do they think that? It is because MicroStrategy, which is now called Strategy, Michael Saylor's firm, its average cost is 74,000. So technicians always look for a marker out there to define the low. We think that institutions have been studying this, and that as in this period where we might be between 74,000 and 86,000, that we will see some movement by institutions to buy into this new asset class. And the latest evidence is that Bank of America, Merrill Lynch, so Bank of America owns Merrill Lynch, is the first company to put a spot Bitcoin ETF on its platform. And what that means is Bank of America's clients were not allowed to build positions in Bitcoin. Well, a few weeks ago, they allowed it. And as they have been educating investors about Bitcoin, they have been informing them about this 4-year cycle. So we think that institutions are going to pick up the slack here, and that we will not have a down round like the 75% we saw in the last cycle.
Cathie Wood addresses one of the most important questions investors are asking. How much lower can Bitcoin really go from here? At the time of recording, Bitcoin was trading around $86,000, with many analysts pointing to $74,000 as a potential bottom. Why that number? Because it happens to be MicroStrategy's average Bitcoin cost basis, a level technicians see as a key psychological support. Wood believes institutions are acutely aware of this level. If Bitcoin trades between roughly $74,000 and $86,000, she expects institutional buying to accelerate, limiting further downside.
We do not believe Bitcoin's going to go to zero because it is a global monetary system, and it is rules-based, and it is good competition for fiat currencies, especially in emerging markets. Now, recently, we've seen stablecoins usurp one of the roles we thought Bitcoin would play in emerging markets. So USDT, Tether, and USDC, Circle, are really on-ramps into the digital asset ecosystem and are streamlining payments. They're almost free to send. You can send very small units. And so as we've analyzed that, we thought, okay, Bitcoin is not going to be the insurance policy that stablecoins are now playing against their fiat currencies. But that wasn't a huge use case for us. If we were at the extreme, our bullish case was $1.5 million. That takes about $200,000 away. So that won't take us down to zero. Many technologists and crypto experts are focused on quantum. We have done a lot of work on quantum technology, and we do not believe there will be any commercial applications of note before 2040, and in the most likely case, we think we will not see them until the late 40s. And in the meantime, that gives Bitcoin and the Bitcoin ecosystem a lot of opportunity to upgrade wallets and alert people out there that, hey, With quantum, whenever quantum is ready for real time, for prime time, beware. If you don't change your wallets over to a more protected status, you will be vulnerable to a hack. Now, there are many wallets that have been lost, many Bitcoin lost, I should say. So that's still a juicy target. And so we're going to keep our eyes on quantum. And we've done an awful lot of work on it recently. Brett Winton, our chief futurist, has been getting so many questions that he's been forced to answer the question, when will this happen? And we really don't think it's going to be until the 2040s. We are not exposed to precious metals, although to the extent you consider gold a store of value, we are exposed, of course, to digital gold, which is Bitcoin. But how do we think about gold in the years ahead? I'm going to take you back to the future. So when I first started in the business, Reaganomics was in full force in the early 80s. And gold had just hit a peak in, I believe it was 1980, of $850. We had the hypothesis, and we were making a forecast, that gold would go down. And the reason was we thought the combination of excellent fiscal policy, so tax cuts and deregulation, along with excellent monetary policy, trying to crush inflation, which was in the double digits, would take away an important role that gold plays, which is store of value, preservation of wealth, preservation of purchasing power. And that's exactly what happened. Gold went down from roughly $850 to $350 over, I don't know if it was a decade, but it was a very long period of time. And I think we're going to see something like that in the next few years. One of the reasons gold has increased here is because many investors are worried about deficits, trade deficits and government deficits around the world. And they're looking for a hedge. This is part of the wall of worry in this market that has also caused worries about the AI hype. When people are worried about the stock market, they seek a hedge, and gold is serving as that hedge. If we are right, we believe the stock market is going to continue to move up, but will favor disruptive innovation, technologically enabled disruptive innovation. We think that is going to continue powering the stock market. We think there will be a lot of confusion because technologically enabled disruptive innovation is going to lead to disruption in the traditional world order. So there will be a lot of stocks that will not do well in this period. But if you're on the right side of change, we think you'll do very well, because we think that we're moving from a rolling recession, where we've been for the last 3 years, into a rolling recovery, and then into a productivity-driven boom. So we think we're moving into a productivity-driven boom in activity, and that will be obvious by the midterm elections in the U.S. next year. We think this administration has engineered tax policy, deregulation, and tariffs. Tariffs, getting those out of the way and moving into next year, a lot of good news. We also think inflation is going to come down, surprisingly. And so why do people hold gold? It's a hedge against inflation. If inflation is moving down And if we're also right that the dollar is going to start moving up again, and then the dollar will be as good as gold, why do you need to hold gold? And you can get a double benefit if you're in the right kind of stocks in the equity market, dollar-based stocks. So you'll have the dollar going up and the stocks going up. So we obviously, and you have to consider the source, this is all we do, we would shift away from gold and other precious metals into stocks focused on technologically enabled innovation. Now, what does this mean for Bitcoin if we're calling Bitcoin digital gold? And yes, it does serve that role, but it is also the most important and the most secure asset, digital asset, in this new asset class. So institutions are looking at it. It is part of a global rules-based monetary system, and it's a new technology. So we think there are other reasons to own Bitcoin.
Cathie Wood's message is not about short-term price action. It's about time, conviction, and structural change. Bitcoin is still early. Institutions are still building positions, and the forces shaping its future are far larger than any single market cycle. Whether you agree with her projections or not, one thing is clear: Bitcoin is no longer a fringe experiment. It's a global financial contender. And according to Cathie Wood, the most important chapters are still ahead.